In 2024, Citadel fund manager Ken Griffin made his investor an average of $200 million per person. This is the result of a hedge fund that is not publicly traded, and that's a total of $16 billion that went to investors we don't know. That's more profit generated by a single hedge fund than most of the S&P 500 companies. Most people don't even know what these funds do because these structures are closed, inaccessible, and rarely disclosed. It's just one of several accusations. Regarding hedge funds, it's necessary to clarify a point that most people don't realize. These funds are defined not only by profitable strategies, but also by how the system is set up and who it is open to. Although this structure, which is inaccessible to everyone, may seem complex from the outside, it actually operates with a certain logic. Therefore, it's not just how the fund invests, but also who it allows to invest that makes the real difference. Before we start the video, I'm curious, have you ever met someone who invests in hedge funds? Or do you do it yourself? Share in the comments. In the meantime, how do investors make money? Don't forget to subscribe to the channel. We'll be sharing more investment videos about hedge funds on this channel. What exactly are these financial titans? How do they work? What is the process for joining their ranks? When markets crash, what makes it possible to make money? You will see how these giants work. Essentially, hedge funds pool the capital of wealthy individuals and institutions and use it for various investment methods. Although they may seem simple, these operators present themselves as market alchemists. Unlike typical managers, these experts must generate significant profits in any economic environment. In developing economies, they must significantly dominate performance. Collapsing markets? They should have predicted the crashes and placed profitable bets. The basic rule is still to never lose customer capital. There are several ways in which hedge funds differ from traditional investments. First of all, they only serve the wealthy. Unlike public investment funds, hedge funds are not offered to ordinary investors. Only qualified individuals who earn at least $200,000 per year or have a net worth of at least $1 million are accepted. Second, they operate with minimal regulatory oversight and maintain a significant degree of uncertainty. They are the wild frontier of finance because they only file a 13F report once every 3 months and are subject to fewer rules than standard funds. Thirdly, they adopt high-risk, aggressive approaches. While investment funds purchase stocks and bonds, hedge funds maximize returns using algorithmic trading, leverage, short selling, and derivative products. Definitions are concise because understanding them is essential. This is a brief example of short selling. Let's say you think the stock will go down, so you call your broker and want to sell a Microsoft share. Someone else will take out, sell, and give you the proceeds from Microsoft shares. You currently have $300 in cash on hand, but you owe your broker 1 share of Microsoft stock. Tomorrow, Microsoft's value drops to 50. You're returning the 50 Microsoft product you bought to cover the difference. Well done. You earned $50. Leverage is the process of using debt to increase trading profitability and position size. If the transactions don't work out, you'll lose more money than you earn. Buffett makes a valid point about leverage. If you're smart, you don't need it, and if you're stupid, you shouldn't use it. Derivative products are financial instruments whose value is based on underlying assets. Typical examples include futures, swaps, options, and forwards. Salary plans are in 4th place. Hedge funds are often priced using the 2 and 20 formula, which claims they will never lose money while providing extraordinary returns. This formula consists of a 2% management fee and 20% of the profits. This allows hedge funds to profit even in the event of a loss. No matter how successful their business is that year, they receive a 2% payment. For example, Bridgewater manages assets worth approximately $40 billion. A mere 2% management fee generates $0.8 billion annually. Let's look at the investment strategies of hedge funds. The basic tactic is long-short stocks, betting against losers and supporting winners. The primary goal of this strategy was to protect positions against market fluctuations. Consider a scenario where hedge funds believe Google is undervalued and Netflix is overvalued. They are simultaneously buying Google shares and shorting Netflix. If any of their predictions are wrong, they will lose money on some positions, but they are protecting themselves against the possibility of systemic market risk or a full market collapse. If the markets fall and Google's assets lose value, Netflix short positions will yield significant profits. Global macro hedge funds conduct their trades based on macroeconomic developments. They focus on currency fluctuations, commodity cycles, foreign conflicts, political unrest, and policy changes. They are benefiting from global changes by using raw materials, stocks, bonds, and foreign exchange. Here's an incredible example. Several funds predicted the impact of a Greek default on European markets during the European sovereign debt crisis. These investors bought German bonds and took large short positions against Greek government bonds, expecting a flight to quality as the crisis deepened. They also shorted the euro against the Swiss franc and the US dollar. When Greece's debt crisis erupted, these hedge funds made significant profits from the widening of bond spreads and currency devaluations. For some, this single macro transaction earned nearly $5 billion. Quantitative hedge funds have the ability to execute millions of transactions simultaneously every day using machine learning and artificial intelligence algorithms. These businesses are faster than human traders at identifying and exploiting small market inefficiencies. A perfect example of this tactic is Renaissance Technologies. Systematic trading models developed by scientists and mathematicians consistently outperform traditional methods. Medallion funds with pure mathematical skill have delivered impressive average annual returns of 35% over several decades. Today, $5,000 would be equivalent to millions of dollars in their early days. Business events such as mergers, bankruptcies, restructurings, earnings announcements, legal proceedings, and regulatory decisions are all profitable for event-driven hedge funds. They are trying to predict the market's reaction to important news and adjust their strategies accordingly. When Fox announced it would acquire 21st Century Fox's entertainment assets, many hedge funds took long positions in Fox shares in anticipation of the premium Disney would pay. Others shorted Disney shares and bought Fox shares, trading in pairs to profit from the difference in price. After regulatory agencies approved the merger, sophisticated investors made millions of dollars from their strategic positions. This review covers the core strategies used by most hedge funds. Now let's examine the industry giants. The manager of the modern hedge fund, Appaloosa Management, is David Tepper. After starting his career as a credit analyst, he developed a special interest in distressed debt investments and launched his fund at an ideal time for market downturns. He made billions by taking a contrarian approach and buying when others were panicking. During the 2009 financial crisis, Tepper made nearly $7 billion by buying bank stocks that everyone else was avoiding. This is one of the largest counter-investments ever made. So far, we've seen how David Tepper made $7 billion by buying bank stocks that everyone else was fleeing during the 2009 crisis. But did you ever consider this critical detail? While Tepper bought Bank of America shares for $3, everyone else in the market at that moment thought these banks would go bankrupt. It was even rumored that the government would nationalize the banks. But what if Tepper was wrong and the banks really did collapse? What was the psychology behind taking such a big risk? Now, to find the answers to these questions, let's look at the strategies of other titans in the hedge fund world. Ray Dalio revolutionized hedge fund management at Bridgewater Associates. Initially starting with principle-based investing, Ray Dalio developed systematic tactics that combined economic theory with practical market applications. The most well-known concept, the all-weather portfolio, aims to achieve consistent performance under various economic conditions through diversified risk allocation. Unlike traditional portfolios, which are mostly weighted towards stocks and bonds, all-weather balances risk across various conditions. Radical transparency and principled reasoning are fundamental components of Dalio's management philosophy. From young analysts to senior partners, all Bridgewater employees need to freely and honestly discuss their ideas. All meetings are video recorded and reviewed to ensure optimal decision-making processes. To achieve better investment results, this culture utilizes social intelligence and systematic error correction approaches. Steve Cohen's transformation from regulatory target to renowned industry leader is one of the best examples of the tenacity and ingenuity of hedge funds. His previous firm, SAC Capital, achieved extraordinary profits in the 1990s and 2000s, by using aggressive trading tactics and top-tier information networks. However, during regulatory reviews, evidence was found that several portfolio managers had engaged in illegal insider trading. In 2013, SAC paid a $0.8 billion penalty, one of the largest settlements in Wall Street history. Instead, Cohen changed his approach and currently runs .72 Asset Management, which includes improved compliance systems and risk management practices at the corporate level. .72 currently manages over $30 billion and is still expanding globally. To further illustrate how unlimited wealth enables a range of investments outside of financial markets, Cohen also purchased the New York Mets baseball team. Carl Icahn is a shining example of activist hedge fund investments due to his 10 years of business experience. The approach goes beyond simple investment. It imposes significant corporate reforms through well-planned pressure campaigns. So far, we've covered the triumphs and disasters of hedge funds. However, don't overlook this critical fact. Research shows that 50% of hedge funds that failed in the last 20 years did so due to operational risks. These are not investment errors, but operational issues such as misreporting, embezzlement of funds, and unauthorized trading. Even mathematical geniuses like LTCM overlooked operational risks. Therefore, the real danger in this sector is not incorrect investment decisions, but how the system itself is managed. Therefore, we will now discuss how you can enter this risky world and what skills you will need. Let's shift our focus from the failures of Wall Street to future career opportunities. If these articles interest you, please leave a comment below for more content. If not, let's examine hedge fund investments. Unfortunately, the first step is to attend elite institutions like Ivy League universities or other prestigious schools. What should be researched? Accounting, economics, or finance backgrounds are examples of traditional career paths. However, newer quantitative methods prioritize computer science, mathematics, physics, or statistics. The increasing popularity of algorithmic trading in systematic funds has increased the value of quantitative skills. Generally speaking, hedge funds prefer candidates with relevant experience over recent graduates. To advance to hedge fund analyst roles, it is often necessary to work for 2 to 3 years in the sales and trading or investment banking departments of leading investment banks such as Morgan Stanley, J.P. Morgan Chase, or Goldman Sachs. This is an example of how Wall Street serves as a challenging training ground for investment banking. To see the true power of hedge funds, focus on the real clients of these giants. Essentially, these sophisticated investment tools cater to only 3 main customer groups. What impact does the reality of hedge funds have on regular investors? Your pay goes down when your retirement fund loses money, but the hedge fund manager still gets millions. The system's skewed side. They gain, you lose. Pressure from regulations is growing. Although lobbying power is important, the SEC wants transparency. In 2024, new regulations were introduced, but they are not enough. They continue to serve as the central component of the shadow banking system. Hedge funds are evolving as a result of the technological revolution. Algorithms with artificial intelligence are outperforming human managers. Quant funds, like Renaissance Technologies, rely on math rather than gut feeling when making decisions. What does this mean for the average investor? The GameStop events demonstrated that small investors can outperform hedge funds if they band together. Melvin Capital lost billions of dollars when it went bankrupt. It resembled David vanquishing Goliath. In the future, fees will drop, transparency will rise, and hedge funds will use technology. Nonetheless, they will have access to corporate capital worth trillions of dollars. What do you think then, in light of this information? Is this hedge fund power fair? Post your thoughts in the comments section. Please remember to like the video and subscribe to the channel if this analysis was useful. Let's keep discovering Wall Street's mysteries.